Hey everybody, welcome back to Markets and Sectors. My name is Mike Fairbourn. It's great to be here with you today, folks. Today, BJ said it early on. It's perfect timing for this class, really, just because just within the last hour, we did have the Fed rate cut of 25 basis points. I want to talk about that today, as well as a number of different points from the economic data that was shared over that event, and just some broad perspectives there, specifically too on interest rate sensitive sectors and what we could potentially see going forward in the markets. So with that, welcome to all of you. We do have Mr. Cameron May in the chat. I appreciate Cam being here, a good friend of mine. I appreciate any comments, questions, folks, you have. Throw those into the chat so we can help address those for you. But it is good to have BJ here. David Riceberg. We've got Scott Speak, Robert Boucher, and others. Welcome all. Let's go ahead and get started. Plenty to look at today, and we'll dive right on into this with some disclosure items. So first off, information here is for general information purposes only, should not be considered an individualized recommendation or personalized investment advice. Now, Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money software application is for educational purposes only. Investing involves risks, including for some products more than your initial investment. Another quick note, just to state here that futures and futures options, which we do look at from time to time, just to get some general perspectives on, involve substantial risks that are not suitable for all investors. Keep in mind some additional points listed there on the bottom of this disclosure slide as it does relate to futures and Forex. Okay, moving on to our final disclosure slide here. Just wanted to note that past performance is no guarantee of future results, and historical data should not be used alone when making investment decisions. The STAX is not a tradable index. The STAX should not be used as an indicator or a predictor of future client trading volume or financial performance for Schwab. So with that, let's go ahead and just jump back to our main screen here and look at the markets, broadly speaking. Well, we could look at the markets. I've actually got gold up right now. Gold is dipping. Now, that's normally where I would have my SPX is right over here. And we did see a dip upon the upon the announcement, the FOMC announcement. And there are some reasons for that that do, I don't know, they do make somewhat, I mean, they do make some sense. And sometimes, we do get, good news and the response is good news is bad news and the market sells off. But there could be some underlying themes behind this. I want to take a look at the markets just first, the S&P 500, and then we'll go through some of that economic data pretty quickly. I've got quite a bit of it organized here to go through. So first off, looking at the S&P 500, we'll just go full screen here to look at it. As you take a look over here, and I have been using just this longer upward trend line. You can see that we did hold along this level. We talked about this the last couple of weeks, and here we are bouncing off it. We said, hey, there's possibility of resistance there, and there's also possibility of kind of around this mean level, around the possibility of support there. And what I had done previously, and this can kind of help to get you started a little bit on those longer term diagonal lines that match both price and time. And that is with standard deviations above and below what is kind of like the average price and time over a particular range. We can use that linear regression. Let's just put that on briefly to show this to you. So it is an indicator linear regression line right there at the 50%, the 50 number, the channel of 50, gives us a couple of these to look at. And you can see it might not organize perfectly around what those levels have been. I did use, like for example, this yellow upper line to highlight where prices have actually been bouncing off of here, and here. But you'll notice down below, we do have this point. We've got this point. These were kind of adjoined with the line I drew up top, as well as just above here, a little bit higher upper channel line. We might have drifted to a little bit lower slope, and so the yellow line that I've drawn might reflect that a little bit better. But nonetheless, here we are coming off that level. My point is here is the midline that I've got right here. If I were to draw a lower channel line, like say, for example, over here like this across these bottoms, which is sometimes, what traders will do over the long stretch. Oh gosh, that's going to be tough to do. Let me do it this way just quickly because I wanted to highlight this regardless. Let's keep those other lines on that I've drawn. But let's go over here and you'll notice something interesting coming up at this lower standard deviation of the main linear regression line. You see that right below here. If I draw across here and draw some of these lines, let's see, how can I do this? I think it was actually back to a 2-year. Let me just do this real quick. Let's clear this off. I've got to show this to you. And then we'll be good to go forward with this. But I just want you to be mindful. Well, you know what? Forget it. I'll just point this out. This linear regression line right here is mapping off pretty interestingly with our midline, our kind of reversion point in the middle between what was a lower, I'll just draw this in, what was a lower channel line. Here was the sort of the midpoint, reversion to the mean, as they like to say, back to linear regression. And it is also on a 1-year time frame, the lower one standard deviation point below this level. Now, as I point this out to you, if we just keep following it along in the future, look at this, where we bounced off of last time. It does line up. I don't know if we'll go to the end of the year or not, but look at this. This point or through here, you've got a high and you've got a low range right there too. So be watching this level. Let's clear this off and I'll just highlight what that price range might be on the S&P 500. There's also a big gap there too, but it's right around, it's just below the 5,900 level. It's about 5,850 or so, right in there. And it's always kind of a band of resistance, right? Or support in this case that could be in there. But watch these lower lines as they do come up, and maybe if prices do bounce off those levels, you could see some support there. Okay. I wanted to point that out because we are selling a little bit off after the Fed did announce a rate cut of 25 basis points. We'll look at some of the sectors here in just a second that are more interest rate sensitive. But as we do that, I wanted to point this out to you on Fred. So this is Fred. You can get to Fred by going to Analyze tab and Economic Data. Now within here, if you scoot down below at the bottom, it does state that this product uses Fred API, but is not endorsed or certified by the Federal Reserve Bank of St. Louis, nor is it, endorsed by, Schwab, for example, or representative of Schwab. It's just that is the data that is being used here. And within this, anytime there is that economic announcement, you can come right over here into interest rates, click on interest rates. Did you see that? I went kind of fast. You go to the home page. You can type in, I'm on home, so I've clicked right here. You can either go into this box and type in interest rates, or it is available for selection over here in this first column. If I click on that, we're going to be looking at FRB, Federal Reserve Bank rates. Specifically, what is the rate that they cut is the Fed funds rate or raise. That's just what they cut today. So I'm going to go ahead and put this in at the top, at the effective funds rate. And you'll notice what I'm going to do. I'm going to zoom in on it right here. We had a couple of cuts this year already previously. We've had another one today. It's not being reflected yet though, but that's just kind of a visual that you can see of the Fed funds rate. So this could just be a good tracker to keep an eye on, all else equal. Hey, where do those rates stand? Where did the cuts come in? And how can I track those? Okay, let's point this out. A couple of just key points. First off, I wanted to state that as we did see the cuts here, there was an expectation for actually 4 cuts next year. They brought that down to 2. So a 50 basis point cut next year, or a 0.5%, and a 50 basis point cut the next year after that. So I'll just quickly jot this out in terms of what the Fed is expecting right now. So 2025, they were shooting for 4 cuts. Now they are shooting for 2, and that's going to be 2 25 basis point cuts. And so that's a total of 50 basis points. 50 BPS, and for 2026, it's the exact same thing, 50 basis points. So the market initially back in March, the expectation was for 4 for 2025. We are getting 2 now. So kind of put that in context a little bit. Now we're getting some of this information out in terms of the cut itself. So think about it this way. The market's falling right now on that rate cut, but notice the expectations for what was going to happen into next year. Let's go back to next year here. Into 2025, out through a larger time frame, there are 2 less cuts. So instead of a full 100 basis points, there's only 50 basis points that the Fed is expecting right now. There are a couple of other points I wanted to note specifically from the Fed meeting too. but keep that in mind, and we'll see what happens. It's still, like we said, good news coming across. I mean, it's a interest rate cut, and that could be stimulative to the market, but it's just not as much as is expected next year. Now, they did say projected inflation. They did raise projected inflation from 2.25 to 2.5. So what is that? 30 basis points, basically. They raised inflation, projected inflation next year. So that's something that's not exactly that positive either. We're just looking at reasons as to why we may have seen a dip over here. In fact, let's just do this right now. I'm going to go into it. Here is SPX. And as we look at SPX over here, let's go intraday. And we'll just take a look. Well, gosh, 1 minute chart. There you go. So that is the Fed rate cut right there, as we're looking at that. So a couple of different things. So higher expected inflation, just moderately, 30 basis point higher expected next year. Less rate cuts. There was one Fed that just dissented, that said everybody else was on board with cutting. The Cleveland Fed said we'll hold the rate steady. Let's see what else we've got here. Let's see a couple key points. Yeah, so they did revise the inflation rate. A couple more to note. Now, Powell did say specifically that the policy is well positioned to deal with risks and uncertainties we face on both sides of the dual mandate. Now, they have an inflation mandate, a growth mandate. So, they feel they're well positioned there, but they have a generally a pretty good feel for it. Powell says still see an inflation story as broadly on track. So that reflects their expectations of inflation into next year. Not a huge jump, but it was revised higher. Okay, and let's see. Did want to take a look at a couple more in here, but okay, I guess we're good on that. Some of the sectors that we saw too, in terms of dipping. Let's go ahead and pull up our sector kind of overview here, a grid of our sectors. Let's see, let's go to a 6-month grid chart. So we're looking at the S&P and you can kind of see, just looking at what's been coming down. In fact, what you can look at here on this grid, in fact, if you guys don't have it, I can send it out to you now if you haven't seen it already, but if you're viewing this in a recording, it will be in the description section under more under YouTube when it does get posted, okay? But look up top here, what's really kind of getting hit in terms of a percentage? When you look at it, we are seeing industrials and materials taking a bit of a hit, but the big and most interest rate kind of sensitive areas, right? Consumer discretionary is on that list. We also see utilities. It's doing somewhat, this might be kind of tied into, it's down, but it could be tied into an inflation projection. Even though there is a cut, we're seeing that. But right now, the biggest ones we're seeing, consumer discretionary and real estate right here. The two most real interest rate sensitive sectors. So these two could, you want to keep a watch on. And really, consumer discretionary has been one of our strongest ones. Interesting too, I did want to take a look at some of the, let's see, here's Infotech. We'll look at this first, but then I want to look at the NDX as well. Okay, so we're trading right down to this level. Now, one thing to kind of consider here, we could see a short-term pullback. We don't know where the sector is going to end off on the day, but when you get these big candles like this, you're kind of engulfing a lot of bars in here. I'm just going to just drag this through here, and we'll see if we do engulf these. In other words, the open of the body of the candle and the close of the body of the candle is engulfing a wide range of candles. So it's not just your standard engulfing pattern like this over here. You engulfed a bar, right? You're engulfing, a week or so, perhaps. Now this bar, obviously slips outside of that range, but what you could see is, the real question is can it hold this key support? Will we stop here? It's kind of holding there right now. And we'll see if it does hold. Let's move from here over into by the way, let's see if anybody did want to see that. I'll send this out just real quick so you have it. This is not a script or anything. It's just simply a grid. So in case you like that grid, it has all 11 sectors of the S&P 500. Let me just share that. It's a real easy way to use hang on a second. 1 second. There we go. Share the grid. Okay, bingo. Put that into the chat box and there you have it. Okay, again, you can find that in the description section under more if you're viewing this section as a recording. Okay, or this session is recording. Okay, let's pop back now and take a look at the NDX, the NASDAQ 100. We had kind of tech heavy, as we said, right? Clearly a tech heavy index, and you can see this pullback to this level. Now, if I were to extend we broke right back down through it, but I'm going to right click on my upper channel line and extend these channel lines that really draw out an ascending triangle here. Let's go ahead and edit the property, and I can simply just send it to the right. You could do that up top here. If you right click on it, you can say right extension, click on. That's just going to shoot it way off my screen, but I'll just do it for now to kind of highlight this. Okay, and we've also got this one down here. I'm going to do this as well. I'm going to edit this property and shoot this one off to the right. There is a bit of a vertex of the triangle that's occurring right over here. Sometimes prices will move when the vertex gets matched, when they meet the top and the bottom lines. But what I'm pointing this out for right now is, where do we close today at? Do we bounce back and hold above this level? Do we bounce off this lower line, which is also, well, it depends on when we bounce off it. Tomorrow, we're kind of getting close to this level. There could be a support test there too. But watch that. Of course, prices could continue to drop as well, but that's just a key point that I wanted to note there for you. Okay, well, that's a bit of the background and what's happening here. Okay, one key point before we end with the Fed's discussion. There are 5 things that the Fed mentioned. Chairman Powell said this right before I jumped on to get ready here, but he did say, I was happy to catch this. He said, growth is stronger, unemployment is lower. Positives, right? On the other side, inflation is higher, and uncertainty around inflation is also higher, which is leading to policy to be a little bit uncertain as well. So they did say they were expected 2 rate cuts, right? Both 25 basis points each, 2025, 2026, but there's uncertainty on the policy due to uncertainty surrounding inflation, because inflation is higher, although he did say growth is stronger, unemployment is lower. So think about this. They're cutting less, right? They don't want to cut too much because, yeah, you have stronger growth, you've got unemployment lower as well. So you're seeing some strength. So that's kind of the positive side. So it's kind of a mix, and you can see what they ended up doing. They just did 1 rate cut. Okay, any questions on that? I know Cam's been busy in the chat, so I'll pull this back up again, and then we'll take a look at our markets and sectors, because there are some interesting things to review here, folks, and I did want to talk about some volume today that we're seeing. It's a little bit interesting as well. So let's go ahead and I'm just going to pull up and see if we have any points here. Oh, Thais says, okay, so the VIX, showing the VIX is up. Yeah, that last candle is pretty big. You're right. And by the way, it's a big day. I mean, it's a Fed announcement day there, BJ, but good eyes on that. And the one thing you could say too is that this candle right here, at least where it stands right now we still have, roughly 40 minutes or 38 minutes left in the trading day. But look at the size of this candle relative to anything you've seen over here. The last one I saw was right there, and I guess the prior one just before it. By the way, that one right there on the SPX. That was actually a possibility of that was a reversal the next day, and we went up higher. We don't know what we're going to get here. We did know that there's quite a bit of range in there. And by the way, you might have been referring to the NDX, which also there, BJ, had a pretty big candle relative to its peers. Prior candlestick peers over here. Last one I saw actually was down towards this bottom here of that size. So those are always interesting to kind of take a look at. Now, moving on into some of the technicals here as to what we're seeing, broadly speaking. Well, the McClellan has clearly dipped lower, and today is obviously having an influence on that. One interesting thing is, with the trend, which we do have, we have the trend still clearly intact. This was a higher high, and in fact, an all-time high on the S&P 500 index, okay? We've drawn in here where some possible support levels could be, that also coincide and could be anchored by historical and horizontal support and resistance levels. So right in there, like we said, about the 58, 58.80 or so range. So we want to watch that, but Notice how the McClellan, which is a reference on the NYSE, it's a bigger basket, about 2,800 plus stocks in there, has weakened. We're down towards the bottom end of the range here. Now, the signal occurs, the bullish signal, according to Tom McClellan, when prices come up, it has to dip below minus 100. Well, no issues with that right now. We're almost to negative 300 as it stands right now. Just above that, you could say, on the negative end to negative 278. But if you get above the minus 100, below the minus 100, and then you pass above the minus 70, what could that do? The trend is intact. Trend is higher. Okay. And that tells us if we get above the minus 70, according to McClellan, a 2 to 3 week rally, 2 to 3 week rally could occur. That would be bullish. It sometimes can be just kind of moderate too, like maybe sideways to a degree as well. But keep that in mind. That could be something that we could look at going forward. Now, there is bearishness clearly down here, especially with the size of that candle right over here. The McClellan Summation Index, a summary of that index, folks. We are dipping low. And when was the last time we were at that low? The lowest on the year right now. The read on that is, well, it's 951.08 as it currently stands, as I'm pointing and looking at it right there. Subject to change, but you'll notice that what we've been seeing here, just in terms of the momentum, it has been collectively weakening, and I think you can see that. One quick note on that, you remember that trajectory line that we had from the linear regression line over here, that was extending higher. It was anticipating higher highs based on what? Based on all this prior data, which tells us that the slope has been getting, folks, weaker. It was a little bit stronger over here. Do you see that? Stronger, but it got weaker. The summation index, bam, picked up on it. Lower lows and lower highs. Now, is that necessarily a bad thing? Well, not necessarily. We're still making highs. Sometimes prices can drag a little bit before they can begin to go up. And by the way, seasonality suggests still the possibility of strength to the end of the year. If it does unfold that way, that's what seasonality on average has suggested. We'll take a look at that in a second. But with that rate cut, could we see strength into January, February, March, which has historically been true if you take out the COVID situation in terms of, the longer term perspective in terms of the seasonality, right? So you've got to be mindful of that. So you could still see that with the cut. We don't know how the day is going to end off, but who knows? We could hammer back a little bit, and we'll see what's happening. Now, to extend this though, the advanced decline line began to flatten out. It stayed in a range for a while, but look over here with me. If I draw a line straight through there, we broke it. Okay, so advancers versus decliners, that began to shift a little bit, and you can see it has turned red. We are moving down. That's increasing. So it's going to be very interesting to go ahead and look a little bit deeper in behind this and see what the equal weight shows us. Because remember, last time we talked, we said there were a number of stocks out there that were heavily weighted in the market itself. Market weightings were high. As we look at, let's go over here. I'm going to take a look at, for example, where are we? Yeah, the sectors. So looking at the sectors specifically, but I wanted to see those actually on the visualize. There we go. Or just actually not the sectors. We could just look at the S&P 500, right? The weightings. NVIDIA's up. By the way, you can see everything else. Many things are down. There's just a little bit of green out there across the 500. But these have really been the leaders. The Microsofts, NVIDIA's, Apple's, the Alphabets, Broadcom. Have a little bit of a sleeper, but it has shown some strength. I mean, Tesla and Amazon. Tesla, I was looking at, it's like 40%, not year to date, like month to date. We're getting close to that number if we're not already above it. I don't know about today, we're down 6%, but that was like 40% on the month. So it was kind of crazy there for a little bit. But the point is that when we look at the equal weight, that's the SPXEW, the S&P Equal Weight Index, that's actually that's a new low in terms of the trend that's extended really all the way from, you could say, January, February. I mean, in terms of a change of possible direction. And that is a big pullback here too. So equal weight, we're actually dipped all the way down to the 30 RSI. In fact, we're just slightly below it right there at 27. So that's where we can see sort of sometimes the cracks in the foundation. If you get too much of the index weakening and the other parts not strengthening enough, you can see some breaking down. We're taking a look at the Hindenburg Omen. Not a lot of spikes on the Hindenburg right here, but you'll notice the line within our Hindenburg really dipping. And I think a lot's going to be shown here in the next week or two as to what this looks like. Looking at the NYA specifically. So now we're looking at the composite. So notice that it's a bigger basket of companies, like approximately 2.8 thousand. 2,800 and change stocks. It's coming down. It's kind of like the S&P 500 equal weight. If this gets taken out right there, I think we need to look at some moving averages, don't we? When we're starting to break down lower here, there's been some moving averages that have been intact on this for quite some time. As we look at the NYSE, broader perspective, let's see. Oh, there's a simple 50. I want to look at a couple of these all together, though. But here's a simple 50. Let's look at a simple 50 and a simple 100. So here's our 100. Here is our 50. We'll show this. Well, I think we might already be below the 50. Let's just see. Let's change the colors up so we can see this. It'd be a good reference point for us here right there. Oh, we're below. Actually, we're testing the 100 right now. Okay, which, by the way, we did last time. This has kind of been an interesting area for the NYA right through here because we did dip a little bit below it, also the 50, and then we kind of ended up bouncing back up above there. So real question is can we hold this level or not? We might have some support with the 50, although we're the 100, although we are trading below that 100 right now as we speak. I'm going to throw the 200 up, and then what we'll do is we'll take a look at the S&P 500 on that 200 as well. These are something we do need to hit each and every week and look at the references of these moving averages to a bigger picture. So there's your 200. So that's the bigger NYSE. Let's look at the SPX. Okay, so SPX right at the 50. Right at the 50. We've got a lot of lines in there. I'll take this one off right now. But there is your the 50 period right at it. So between the 50, there's a lot of horizontal support, not to mention the diagonal sloping trend line, which is really kind of like that main linear regression line. And lastly, let's look at the NDX right now. Above all of them right now. Okay, it's a big candle coming down as BJ pointed out, but look at this right here. Prior high, prior low, and the bottom of the ascending triangle trend line too. Okay. So hit a few of those. Let's go back to our NYA again and take a look at it on a weekly basis because we want to see if we're getting any omen flashes, and we did get one right there. So remember, this is important. This is coming. I guess last week is where we saw that. It's funny. It's kind of between 2 weeks and 3 weeks ago, but we're getting one that came up now. The reason why I want to highlight this is because, yeah, this represents kind of a fracture between 52-week new highs. I'll put a little dash underneath it, and lows. If you get a substantial number of lows occurring while highs are occurring, you can get that omen spike over here, which oftentimes happens when, notice over here, our omen line, the Hindenburg, I guess, line starts to dip lower, and we're seeing that right now. Now, if you get several of these spikes, it can be an indication as how traders use it. You're just getting a lot of new lows in the market, and we're starting to see a little bit of fracturing with the SPXEW. Now, this can reverse course. It can reverse course, and it's not unusual to see this. I want to highlight this because we did see 3 over here. But look what we did. We actually kept the trend up. Where it does become unique and interesting is when the trend begins to go down. What were we just barely looking at, folks? What were we just barely talking about? The trend over here. So like I said, in the next week or so, and maybe even the next couple of days, we're on a weekly chart here. But when we looked at this on a daily We were touching right off these lows. I'm going to reverse to this right now because that could represent our change in trend. If we break this and then we make a lower high and a lower low, we may begin to see some Omen spikes down here on the Hindenburg Omen, and that could be something to keep in mind. Let's go move back to the daily quickly here. There we are on our daily. Okay, very good. There's the daily, and that was the line I was representing to you right there. So we had broken, and while we broken the 50-day, the 100 thus far, the market's not closed yet, 30 minutes still left in the day, and we're right at that level. Sometimes when you're right at that level, do this. Do this. See if you are forming a base on a shorter term chart. There's the 5-day, 5-minute. And you'll notice we did dip pretty hard to that level, and we're starting to kind of hold it here. Now, what some traders will do, if they think that there could be long-term support that might bounce off that level, because it could still be an area where some traders would be interested in the possibility of a bounce. But can we start to see, at least on a short-term chart, whether that be an hourly, a 30-minute, 5-minute, can we start to get higher highs and higher lows over here? That's the question. That's what we have to wait and see. We don't know if we'll get that, but we can keep eyes on it too to see what does happen here. But okay, so still the possibility of fracturing and an Omen weekly spike. It's always start with one spike anyways, so let's keep an eye on it to see if it starts to break down, because if it does, that could start to have an impact on the S&P 500 index. It could also have an impact on the NDX, which would what? Influence the sectors that we look at, that many of you might be looking at or even potentially trading, or the stocks within those sectors. So we kind of start big picture, and we can start to see if that unfolds or not. Okay, let's go ahead and click over here. Now, we did make a little bit of a new low over here. It's still not too unusual. We had only, I would say, a new low. It's a new low in NYSE 1-year highs. It's a new low in new highs is what that is. But if we can hold and reverse higher here, we'd be expecting kind of a spike to get north of maybe that 250 level. So like I said, this next coming week, the week after, should be very interesting to see if what has sustained, what we've seen behind the scenes with these newer highs, how it's kind of aligned itself with the trend, which is what we've got behind the scenes here. I'll put this one in yellow, but we've had these continuous spikes in new highs. Ooh, that was the highest point right there at 453. But over here, again, we're still looking at the NYSE new highs. So interesting things to kind of take a look at. All right, let's see. What do we have? Looks like Cam's got us covered here. Appreciate that. And yeah, it's right. Randy, you got it. It was flagging on the weekly. Hindenburg was flagging on the weekly. Yeah. Where's Santa Claus, says Pete. Exactly. Where is, I don't know. But getting close to the end of the year. We'll see what we've got. Now, this is, okay, so that's the SB. I've got it on a 10-year. So this is just seasonality. And this is the seasonal move on average. Again, folks, this is just average. It doesn't, I mean, it's made up of strength. It's made up of weakness. But it has been reflective of a seasonal move. Like we took out these highs. We took out these highs. This is what's happening this year. Up top this is the year to date, right? Year to date performance of the SPX. Down below, this is the average 10-year. Looks very similar to the 5, looks very similar to the 20, but you'll see this move over here. It does. Let's see where we're at. Let's try to draw that down. Interesting. It actually does dip. And I need to draw it. Okay. I'll draw it correctly this time, the best I can in my freehand. Let's see if I got to go slow though. There we go. Just go slow, go slow. There you go. So it looks like, what's funny, and sometimes you'll see these reversal points, but this might line up with that low on seasonality. And then we'll see. Does it or does it not? I mean, it could line up with the low. The question is will it go up with the high? And then, we did just get a cut of 25 basis points, which is stimulative to the economy. And can that 25 basis point cut continue? I'm over here now. Sorry, I was told. Somebody said, hey, you move your cursor too fast, and I get that. I'm trying to get to the spot, but you guys got to see what I'm doing. So I'll slow it down a little bit, but going to get over here. And by the way, if you take out the COVID pandemic issue that happened, I hope it doesn't happen again ever, but every 100 to 150 years, a pandemic like that will strike the world, and is what they had mentioned previously. But if you take that out, we tend to rally up to March and then start our consolidation. So if you just take out that, March is what had been one of the stronger months, if not, I think November and March were the two strongest. But anyways, that's where the COVID thing kicked in. So we don't know. Will it continue to rally? There's a lot we've got to wait on right now, right, to see what we get. There's your 30-minute chart. Okay, that is really reflecting, for those of you just coming and joining us right now, that is our 25 basis point cut right there, right on time for the dip. Question is will we kind of hold that longer term trend? What do we see big picture in terms of, broadly speaking, the SPX EW, the equal weights, as well as the bigger baskets with the NYSE? And how can that give us a sense of what we might see in our sectors, which is what I want to go to right now. Hit it again. We did hit the sectors initially, but I want to take a look at one other quick point on the sectors as we get into this. And let's do that again. I'm going to just jump back to it real quick, and then we'll venture forward here. I like to detach this up in the upper right-hand corner as well. So you can detach right there, and it gives you a little bit more space like this up top. So, because more space is better in this for sure. But are we seeing anything that's showing strength there? In other words, do you see anything that's not negative? Let's just go through this right now. Staples is holding up the best. That's a defensive play. I'm sorry. The two defensive plays are holding up the best. Okay. Down, roughly 0.5%. Everything else down, what I should be doing? My gosh, Mike, take advantage of your red. There we go. Yellow doesn't really mean up, I guess, but we'll say it does in this case. So down, these are 2%, 2%. This is the 4% now. When we started, I think it was 3 or so. One still, 2%, and then finally, all collectively, to the SPX down here. But the defensive plays up top. Defensive plays up top, right there. The two defensive plays, Staples and healthcare, could be of interest to people that are looking for, and we had said this, I want to say last week a little bit, but the prior couple weeks and back even to the third week, we said, if there is a pullback in the market, sometimes it's those defensive type sectors that can perform better out there over a long stretch. The first one is the Staples. I mean, they can perform in good times and bad. Of course, they're made up of individual companies, but they call them defensive for a reason, right? And let's go to the next one. I'm just going to click the arrow. There's healthcare. It's been down, totally different from Staples, right? Staples has been actually not quite a new high, maybe touching the high, kind of consolidating, but over here, if you look at it, a new low in healthcare, but not a new low today. So those could be a couple of areas that we could keep eyes on too in terms of Staples, if in fact the markets, let's revert back to the markets. If the market itself, SPX over here, bottom right-hand corner of our screen, if that can't hold support. And by the way, BJ and everybody, that bar, I think it's looking a little bit bigger than it was when we first started. So we'll see what happens with our SPX there through the rest of today and the rest of the week and maybe into the first of the year, clearly. So, all right. Let's continue. We've got a couple more things. I did want to take a look at our market forecast and our volume before we're all set. Folks, before we do that, I'm going to pause for just a moment. Oh, there was a request from Thea. I'll take a look at that too. Yeah. Oh, let's just hit that right now. So let's see. Thea says, okay, can you please go over the 10-year and 2-year charts? Yes. Yes, like for example, we can do that. Let's do that right now. In fact, I'm going to just back out of this guy. Oh, sorry, let me do this. Oh, I know, I've detached that. That's why I can't see anything else. So some have been saying, and I'll go into the market forecast. We'll take a look at some other details here in just a second, but some have been saying that when you get the 10 10-year, I'm going into futures right now. This is the 10-year. Okay, the 10-year is showing some strength right now. Okay, in terms of where are you know the rates, that where is the 10-year rate itself? It's jumped up. It's showing a range over here. There is a prior high. Now, I would anticipate the dollar. The dollar is up as well, as you can see right there. The dollar is up. So the dollar is showing some key strength too. Ooh, that's a big break. That's going to hit gold, and it is hitting gold. Yeah, down 58, huge. Okay, so anyways, it's above our big 50% level. We'll see. I said huge because it's kind of a big, well, it's at 2%. It's actually a little bit less than some of the market indices, but it is down 58. That is gold, and as the dollar spikes up here. Now, if you take a look at the 10-year and the 2-year, and you can get that by just taking this over here. You just go the minus 10y to minus 10y, excuse me, I'm sorry, forward slash 10y minus the forward slash 2yy. That is your yield curve, okay? And is it normalizing above the zero line? If you look at the 10 minus the 2, so how are long-term rates doing relative to short-term rates? Well, they're doing better because prices have been going up. So keep that in mind, and we might be normalizing above that zero line. You can go back and look at these definitely longer term to just kind of see this. I'll just go to a kind of a 2-year here to show you how we had been below that zero line where the short-term rates were outpacing the longer-term rates. But now that's kind of more normalizing, getting above that zero line and holding. So that can be reflective of a couple of things that Powell said. Growth is stronger, unemployment is lower. We'll have to see what happens with inflation because they did say it's higher, and they expect it to be higher, and there's uncertainty around that inflation, which is leading to uncertainty around the policy. Okay, folks, bottom right-hand corner of the screen, if you get a chance, smash that subscribe button, and if you are up to it, you like today's presentation, you got something out of it, love to see, if you're okay smashing that like button as well. All right, well, with that, let's go over into our moving from this, let's go into our market forecast now. We'll go full screen again. And the market forecast is still, even with this massive, this growing bar, look at this over here. We're still above 80. I don't know if we'll hold above 80. We'll close above 80, but there's 80. And so generally, if you're holding above 80, it doesn't matter the direction of the line, although we're getting close to it. So you really kind of have to watch this. But the market forecast, the way that some traders will use this intermediate term line is they'll say, it doesn't matter the direction. If you're holding above 80, then the market's giving you a go ahead. Maybe you can look at opening new positions. The one thing I would say though is that is a big down bar, and it's close to 80 already. So there are couple of things that could cause us to sort of pause there a little bit, right? As we look at that. Volume, specifically volume profile. We are using the E-mini to help us with this a little bit, S&P E-mini contract. And the key point I wanted to make over a 1-year chart, because we did have a big dip. Look over here with me. This is how this works. Remember, this takes the volume that we see along the bottom here, the horizontal area, and it puts it into the actual prices that volume came in at. So the volume spikes represent support and resistance. This red area over here represents the point of control, which is the biggest volume that we've had over the past 1 year. But really, I'm just looking for the spikes. And by the way, you can get this indicator just by adding it in. It's just referred to as volume profile. Just add it in, your little dropper icon right there, a little flask, I should say. Okay, but notice over here with me, if you dip down below that level, let's use yellow against that blue. If you dip lower here, there's a lot less, there's less volume. And so what happens is there can be, from this point to this point, price acceleration. According to the volume profile, there's just less people that have taken positions here, so there can be an acceleration. Where does that point kind of spike? It spikes right over here. And what price is that? This is the key point I wanted to show, and we'll finish up on this, but this is another area you can keep an eye on. That level where the spike comes back in is about 58.80. And wasn't that the area that we said that there was prior support to, right here? A little bit below it, but resistance and support. So this could really be a key area, because if we break that, well, there can be some additional dips in volume before we reach all the way down to this point, these volume nodes. All right. So there was a lot there, folks. Hopefully, the whole point of this discussion today was really to review, what might be some of the expectations going forward with the Fed. Expecting 4 rate cuts in 2025, then reducing that down to 2 for 2025 and 2 for 2026. We talked about that. Both of those 50 basis points each. We looked at the markets. We talked about the short term, being mindful of the short term trading around these key support levels, particularly on the SPX EW, right? That broader basket of securities. And will that, if we do get a break, does that lead into further indications of weakness in the broader market, like the S&P 500, the NASDAQ 100, things along those lines? So NYA, SPX EW, keep eyes on those, folks. Good being with you. Thanks so much, Cam, for your help in the chat, folks. Give us a follow on X, as Cam has noted there. All right, all. Have a great rest of the day.